Welcome to Middle Class Matters. 8th June 2023. Let us study further the Supreme Court Committee report on Adani shares. Point number 13. The committee desired to know the presentation of the various Adani stocks on any stock index in India. It was found that Adani Enterprises and Adani Ports had minuscule representation in the Nifty 50. Cumulatively 2% on January 24, 2023, while the other Adani stocks had representation in other indices such as the Nifty Next 50, Nifty Mid Cap 150 and Nifty 100 ESG. Point number 14. Therefore, impact of Adani Group related events on the overall market was low on account of index weightage being nil in sensex 30 and around 2% in Nifty 50, except for a short flip period of about 2 weeks since January 24, 2023. The Indian stock market continued to perform well, vis-a-vis the msci emerging market index, and the two have recently converged. The committee examined these facts based on facts presented by SEBI. The committee also engaged with market participants with experience and did not restrict its engagement to discussions with the Securities Market regulator. Point number 15. Data provided by SEBI suggests that after the volatile effect on the Adani Group stocks, participation by retail investors in ownership of these securities has in fact gone up. Such enhanced participation by retail investors would be a classic pointer to markets reacting to price falls. They can lead to a herd mentality of everyone moving in one direction, but they can equally lead to views contrarian to the herd, developing into a counterweiling force on price discovery. Point number 16. Between January 24, 2023 and February 27, 2023, the market capitalization of Adani stocks saw significant erosion in value terms, around rupees 12.4 lakh crores. This reduced to around rupees 10 lakh crores by March 9, 2023. However, deeper analysis of this is warranted. Computation by SEBI shows that A. As on January 24, 2023, all individual investors, including retail investors, any investor with worth under rupees 2 lakhs in value of holdings in a classified as a retail investor, and high net worth investors of approximately 33 lakh unique investors taken together held approximately rupees 57,500 crore worth shares of listed Adani Group companies. B. Maximum value erosion witnessed by these shareholders between January 24, 2023 and February 27, 2023 was approximately rupees 29,200 crores, around 51% value erosion. C. Subsequent to the reversal of price trend post February 27, 2023 in Adani stocks, this value erosion came down to around rupees 21,850 crores, around 38% value erosion only. D. While it becomes apparent that at first blush it had appeared that the losses suffered by small investors was in several lakhs of crores of rupees, computation submitted by SEBI places the loss of value of retail investors in Adani stocks at about rupees 3,700 crores, and E. When one adds to this the value lost by other individuals, including high net worth investors, the loss in market would aggregate to rupees 22,000 crores. Point number 17. SEBI has computed these values after excluding the significant number of shares purchased by individuals after publication of the Hindenburg report and adjusting for net selling by individuals exceeding their holding on January 24, 2023, either by way of short selling or due to selling of shares received through off-market transfers, etc. after publication of the report. Point number 18. Volatility in an entire market could emerge from macroeconomic conditions or developments that have a market-wide impact. For example, the onset of a pandemic could impact stock markets around the globe. Likewise, a fiscal crisis, a currency crisis in a market, or war could lead to the stock market in that jurisdiction getting volatile. So also, circumstances of uncertainty about individual companies could lead to securities issued by that company experiencing volatility. Point number 19. Securities issued by the Adani group appear to have steadily kept rising over the past few years, and after the Hindenburg report was published, they dramatically lost value. The recovery of prices in these stocks after some remedial measures such as cutting off exposure to debt backed by pledge of shareholding in these companies and procuring institutional investment in the securities of these companies, although not high enough to bring these stocks to pre-January 24, 2023 levels, has also been substantial. Point number 20. SEBI has submitted findings of a review of a sample of 35 global stocks that have been targeted by activist short sellers. Generally, three price-related outcomes are seen. A. Stock price falls significantly but recovers. B. The stock price falls significantly and fails to recover. C. The stock price remains largely stable or rises regardless. Point number 21. According to data presented by SEBI, using the impact on Adani enterprises as a benchmark, it is the flagship Adani listed company accounting for 25% of market capitalization of Adani listed stocks, excluding very recent acquisitions like ACC, Ambuja Cements and NDTV. The maximum fall from the prices prior to January 24, 2023, when the Hindenburg report was published, was about 65% on February 27, 2023. As of April 19, 2023, the fall has been mitigated to 46%. Point number 22. The committee sought from SEBI a volatility assessment of the Indian securities market for period starting between January 2020, that is prior to the COVID-19 pandemic, and now. Specifically, the scenarios emerging from the impact of the pandemic, the Ukraine war, the bank failure in the US, publication of the Hindenburg report. The committee desired to study the market-wide volatility and stock-specific volatility. Point number 23. Looking at casual factors, it could be seen that in the case of fall in prices after the pandemic broke out, evidently the casual factor to which one could attribute the fall would be the pandemic, and one could say that the pandemic caused a 33% fall over 6 weeks. Such a casual factor is so significant that it would overshadow and overwhelm any other factor that contributes to price discovery in the market. However, when an event is company specific or even industry specific, it would be tough to attribute movements to any overwhelming and supervening cause. Point number 23. Looking to casual factors, it could be seen that in the case of the fall in prices after the pandemic broke out, evidently the casual factor to which one could attribute the fall would be Point number 25. Some macro global factors need mention at this juncture. The prices for stocks that form part of an index and the movement in stock indices are largely determined by the quantum of money chasing the asset. Put differently, their level of liquidity has an impact on price discovery. Greater the quantum of funds being invested, higher the price is likely to be. The loosening and tightening of money supply is an evident factor. If the US Federal Reserve tightens or loses liquidity, other central banks are expected to react. As money supply changes, the quantum of funds that gets invested in assets also varies. Point number 26. Likewise, events that have a worldwide impact tend to lead to flight to safety decisions, where capital abandons foreign assets and investors tend to cash out and return to their home jurisdictions. For example, when Ukraine war broke out, investors from US would tend to move monies out of the emerging markets to safer zones in their own jurisdiction. Point number 27. Emerging markets, understood globally to be the markets of developing nations that are increasingly getting integrated to the world markets, experience the impact of macro level global trends. Typically, a global event such as the Ukraine war would impact all emerging markets, subject however to adjustments for country level differences among them and peculiarities in their features that could lead to relatively lesser capital outflow or relatively greater capital inflow in that market. Therefore, comparing a country's market index within an index that reflects emerging markets as a whole would be a good way to adjust for global factors. Point number 30. Therefore, when studying the causes of volatility, one must pick the period carefully, and the duration of the event need to factor in the period in which the trend continued. Point number 31. SEBI submitted that the events related to Adani Group companies did not have any significant impact at the systemic level. While the sellers of the group have seen significant decline in prices on account of selling pressure and may have dominated media attention, the markets remain largely stable and resilient. Point number 32. The representation of the Adani Group in major India equity indices is relatively minor, given the limited free float market capitalization of the group. And as a result, recent events did not pose any systemic market level risk. Point number 33. According to SEBI, Indian markets have seen far higher turbulent times in the past, especially during the coviet pandemic period, where Nifty 50 fell by around 26% during the period of March 2nd, 2020 till March 19, 2020, that is within 13 trading days. Point number 34. Even during such turbulent times, the markets continue to function in a robust manner, recovering far faster than other global markets. Investor wealth, that is market capitalization of all listed companies, which was around rupees 145 lakh crores in February 2020, has almost doubled to about rupees 270 lakh crore now. Further, overall market volatility in India is on par with or lower than that in major developed markets. The following graphs were presented. One is comparison of the movement of msci EM index and Nifty 50 between January 24, 2023 and April 19, 2023. The performance of Nifty 50 vis-a-vis MSCI EM index from January 24, 2023 to April 19, 2023. See Adani Enterprises prices from January 24, 2023 until 19, 2023. Point number 36. Based on these data points and the graphs, it has been brought out that A. While Nifty 50 fell after January 24, 2023, MSCI EM index rose, outperforming Nifty 50 for the next 2 weeks till February 6, 2023. B. During the 2-week period from January 24th to February 6, 2023, when Nifty 50 underperformed MSCI EM index, the maximum underperformance of Nifty 50 vis-a-vis MSCI EM index was around 4% on January 27, 2023. See, subsequent to this short 2-week flip, Nifty 50 has consistently outperformed msci EM index except for a short period of 3 to 4 days when the returns of the two indices relate to pre-Hindenburg prices were more or less same. Thus, even if it is assumed that the entire 4% underperforming of Nifty 50 relative to msci EM index was due to Hindenburg report, the overall finding is that the Hindenburg report had a negative impact on Nifty 50 only for a short period of 2 weeks immediately following the publication of the report, and the maximum extent of this impact was 4%. After 2 weeks, the Nifty 50 bounced back relative to msci EM index and continued to outperform it. Like the video, share the video, subscribe to the channel, give your comments. Thanks for watching. The next video will continue on this.